What's up guys, this is Hippo and today it's a very different kind of video. If you're new to the stock market or have been thinking about investing in stocks, this video is for you. I wish I had this kind of video in the beginning when I had started. So this is essentially going to go over what I would have done in the beginning if I were to start today, what kinds of companies I should invest in, also to kind of give you a bit more of a educational overview on perhaps generic things you should know about. But before we start, here's a baby hippo. I think that deserves a like, don't you? Alright, so to start with, here's some basic rules that I myself stick to, and I would recommend anyone to at least consider them as well. First one, as the great Peter Lynch said, you need to invest in what you know. If you're investing in a company, you should be able to understand that company's business model so well that you can explain it to a 2-year-old. I mean, in theory. In practice, it might be different. But generally, you need to be able to understand the company very well and don't invest in, niche biotech plays that perhaps you wouldn't really understand unless you're in the field. So know your company. This video is not going to go anywhere deep enough into every single company. So you need to be able to do your own due diligence and make a decision for yourself. Don't buy a company because people are saying to buy it. Same thing, don't sell a company because people are saying to sell it. You need to be able to understand that company so well that if it rises or drops tomorrow, you will know why. If the company drops by 50% tomorrow, are you going to have enough conviction to say, that's fine, I'm going to buy more, or are you going to sell it? And that's what really makes a difference over the long term. Second point, diversification is so real. It is the best thing you can do against volatility for your portfolio, against macroeconomic and microeconomic events. Whether the CFO of one of your companies was indicted for fraud and then the company stock tanks by 50%, or whether there's an economic recession or crash, you need to be able to diversify your portfolio well enough so that if one of them drops heavily, it's not going to impact your entire portfolio. No matter how many YouTubers will tell you this, there is no golden rule for the amount of companies you should have in your portfolio. You can have 5 companies in your portfolio, you can have 80. It doesn't matter as long as you know the companies you're investing in. Okay, there is no one rule fits all. Third point, and this one is very key. If you cannot sleep at night because of your portfolio, because of your stocks, you have invested too much in the stock market. So you need to really consider that. Obviously, we all want to make money from the stock market, but if you're putting so much money that you can't sleep at night because of it, then you need to trim your positions. And the last point for me is the most important point, and if there's one thing I need you to remember in this video is this. Identify what kind of investor you are. Are you a long-term investor or you're a short-term investor? And stick to it, because different types of investing philosophies will lead to different events. And for example, if you're a massive high-risk, high-reward type of person, you will be probably investing in very speculative stocks that are usually more short-term plays. If you're a long-term investor and you don't mind the risk, then you need to be able to have a stomach that can withstand that volatility over the long term. For example, of these speculative plays like penny stocks. Warren Buffett always says the stock market is a device for transferring money from the impatient to the patient. And this is so true. This is so true. You have to be able to be patient enough to know your companies and to always remember that you are a long-term investor and not halfway through compromise and become all of a sudden a swing trader. I'm going to leave you with this quote. No matter the talent or the effort, some things just take time. Okay, so there are 6 types of stocks that you can invest in. Okay, so you see the first here are blue chip companies. So these are established, stable, well-recognized companies that have the reputation to weather downturns and operate profitably through both the good and the bad times. So these are essentially the safest stocks in the market you can think of. So think of companies like Microsoft, Apple, IBM, Coca-Cola, Disney, etc. Next are growth stocks. So these would be companies that are expected to grow their sales and their earnings at a faster rate than the market average. These companies generally do not pay dividends because they want to reinvest all of their earnings in the company in order to accelerate the growth. So usually in their R&D. Companies would be like Netflix, Spotify, Tesla, Unity, CrowdStrike, Upwork. I've covered Unity, by the way. Feel free to click into the link that's going to pop up above if you want to see my analysis on it. Next are dividend stocks. So these are companies that pay out regular dividends. So these are essentially payments of profit made to investors who own the company's stock. So these are usually well-established companies, so like blue chip companies, with a track record of distributing their earnings back to their shareholders. So this is something you can see in most blue chip companies like AT&T, Morgan Stanley, Johnson & Johnson, Visa. In order to find whether a company actually pays out a dividend, you just have to go on a website like Yahoo Finance, type in the stock, and then here on the landing page, usually you'll see here dividends. So forward dividend and yield and ex-dividend. So basically this company, Visa, pays out 1.28 in dividend per year. So you just have to divide that by 4 quarters, and that's what they would pay per quarter. And ex-dividend date is essentially the date that you would need to have owned the stock for until, so that you can get paid out on your dividend. So if you buy the stock on May the 14th, you're not going to get paid a dividend for that quarter. But if you buy it on May 12th, you will have it. Next are cyclicals. So these are companies whose stocks are cyclical like the economy. So these would be, for example, airlines, clothing stores, hotels, restaurants. So when the economy is doing well, people can afford to, for example, buy new cars, go out to restaurants, etc., upgrade their homes, shop and travel. And these are the companies that are cyclicals, like Delta, Hilton, Apple, JP Morgan. These are not exclusive. A company can be a blue chip as well as a dividend and a cyclical company, okay? That's why you see Apple here as well. Next are defensive stocks. So due to the constant demand for their products, defensive stocks tend to perform much better in a declining market. So for example, companies that are in utilities or consumer staples or in healthcare, these are essentially always in demand, even if there is a crash tomorrow. People will always go to Walmart. People will always go to Kroger to buy their groceries. Pfizer, same thing. McDonald's as well. Utilities, water, gas, electric, of course, as well. Next are speculative stocks. Is there high risk and high reward? These companies are extremely risky because they are not profitable yet, usually, and they are very early stage. And also because they are volatile, short-term traders, so for example, hedge funds, love them, making them even riskier and even more volatile. So this is not for the faint of heart, and I usually would not recommend this to beginners when they invest in the stock market. So types of speculative stocks are, for example, penny stocks, emerging market stocks, like based in China, for example, meme stocks like GameStop and AMC. By the way, if you want to see my video on Yushin, feel free to check it out. It's going to be in the link that pops up above. All right, so that was the sizzle. Now here's the steak. If I were starting today on the stock market, these are the 5 industries that I would target: tech, retail, finance, food and beverage, and healthcare. So technology is essentially the best performing industry of the stock market, and it is simply the future. Companies in this industry that I would invest in are Microsoft, Apple, Amazon, Google, and Facebook. Doesn't get much easier than that. Next are retail companies. So basically, this is a great defensive sector. Regardless of recessions, and we will have recessions, there will be a crash, these companies will be doing very well even within those downturns. So I would invest in any of those: Walmart, Costco, Home Depot, Target. Finance. So financial companies are great cyclical plays. When people will have more money to spend, the companies that will benefit from these transactions are financial companies. So I would invest in Visa, MasterCard, Morgan Stanley, PayPal, Square. Actually, Morgan Stanley just recently doubled their dividends, so it's a very interesting opportunity there. Next is food and beverage. The food and beverage companies, these are the most simple business models to understand and usually some of the safest plays. This is a sector that's relatively steady, in demand, and it will always be growing regardless of the economy. Peter Lynch made over 2,400% for the Magellan Fund, investing in companies like Heinz and Dunkin' Donuts. So I would definitely pick at least one F&B stock in my portfolio. So you'll have here McDonald's, Domino's, Wendy's, Starbucks, and finally, healthcare. I mean, I don't really have to say it, but I will. We are in a pandemic, and healthcare is the #1 sector with the most media attention on it right now. It's normal because there will always be a demand for drugs, for pharmaceuticals. So I will always think a healthcare company in your portfolio is a very good diversification strategy. And I would invest in any of these: Pfizer, Johnson & Johnson, Merck, Eli Lilly. But investing in companies is good and all, but you also need to be able to understand what it means to be an investor. And there are quite a few books out there that are very good at helping you understand the stock market, helping you understand how to invest properly, how to analyze companies with their valuations. And so, for example, one good book that I would recommend is Peter Lynch's One Up on Wall Street. It's an excellent book. Another one would be The Intelligent Investor by Ben Graham. But yeah, that's it, guys. This is a very different kind of video, more of an educational topic. Let me know if you like this kind of video or if you prefer just me going through company reviews for stocks. And I'll see you in the next one, guys.